Hello everyone, and welcome to the next in our series of short webinars. Today looking at tax and associated planning for property owners, this time in relation to the awful coronavirus. Anyone who's been in property long enough will know that fortunes change in a heartbeat and the actions of a few affect us all. Here's a few examples of market crashes that have happened just in my working lifetime. Whether it's Black Wednesday, the dot-com crash of 2000, Lehman Brothers' demise in 2008, or the Greek bailout, they've all had an effect on property values, and it'll be naive to think that coronavirus is going to be any different. If we believe what we read from eminent sources from all around the world, Covid-19 is going to be similar, only worse, just possibly much worse, with some predicting the worst recession in 100 years. But we think there may be better news for those who recognise the situation and are ready to take action. I was told a long time ago that the most important financial decision you'll ever make is not how to make money, it's how to keep it and how to maximise it in legal and compliant ways. And that's what we're going to focus on today in the context of tax planning for property owners, ahead of a drop in property values and in the event the worst happens. And let's face it, we're all going to die someday. Right now you're here, and where you want to end up is here. You'd like to get there like this. The journey is going to be more like this. And these are the points where you need help. In a nutshell, as property tax specialists, going forward, we can solve all of your tax problems legally, ethically, and responsibly, or you focus on the deals that matter. And having had face-to-face meetings with literally thousands of property owners over the years, we don't often get presented with problems we haven't seen before. That hands-on experience means we can fix property tax problems by working directly with you to legitimately minimise your tax while making sure you understand and fulfil your legal obligations. We are Rethink.Tax, and we specialise in socially responsible tax planning for property owners. Now, I know that means different things to different people, but I'm absolutely sure it means something to everybody. To us, it means the right amount of tax on time, every time, but not a penny more than is legally due. Think of it this way. Here's the taxes you paid, here's the taxes you could have paid, and here's what you saved. Your money to do with as you decide. Okay, on with the show. Today's topic, property tax planning in the light of Covid-19 or coronavirus. We're going to start with, is now a good time to transfer property? And then we'll move on to look at why it's important to check that your existing planning actually works. And then finally, take a look at what if the worst happens, because it may not be too late to plan for that. Of course, in today's Covid-19 lockdown climate, we need to emphasise the reason we pay tax is to fund vital public services. And right now, that's more important than ever. And here's where we come in. Nobody is required to pay more than their fair share. I'm here to chat with my colleague Neil Byrne. By way of introduction, Neil is a chartered tax advisor with more than 20 years property tax experience. He used to work for Her Majesty's Revenue and Customs, that's HMRC to you and I, and he's also ex-PricewaterhouseCoopers, or the mighty PwC. And I'm going to ask Neil a few of the property tax planning questions which are particularly relevant to property owners in the current crisis. Today, we're quite deliberately going to go a mile wide and an inch deep. And then, for those who want to, we'll go an inch wide and a mile deep by way of a free, no obligation, personal one-to-one Zoom meeting in which we'll look in more detail at the planning which is most relevant to you. Throughout this presentation, and again at the end, we'll invite you to review your current planning and to make sure it's fit for your purpose or to properly start tax planning for your future. So, Let's get started. Neil, welcome. What are the benefits of transferring property to a company?
Hello, Martin. Let's jump straight in and start why I believe right now might be a good time, really good time to transfer property. The simple reason is that if coronavirus causes a drop in property prices, then there's less of a tax cost to transfer or sell properties, and that makes it a really good time to plan for two reasons. First, the transfer of a property to a company is treated as a sale at market value, and while you could be subject to capital gains tax and stamp duty land tax, there are some reliefs available, especially for CGT. But now is a really good time to think about transferring business property into your own company. Second, as the transfer takes place at current market value, if the property has fallen and your property is worth less, then the tax you pay is calculated on what the property is worth today. For example, let's say you acquired a property in 2012 for £300,000 and last Christmas it was worth £500,000. If you transferred or sold it in January of this year, you would have tax to pay on £200,000 gain. That's tax of around £52,000. If coronavirus causes the property's value to fall to say £400,000, then the gain is just £100,000 and the tax is around £25,000 less.
Okay, so what's the position with SDLT?
Transfers by way of gift don't usually attract SDLT unless there's debt involved. If there's a mortgage or a loan, there's a bit more work to do, but it can be sorted. Transfers to a company are subject to SDLT unless the property is owned within a property partnership where relief may be available. We do a lot of work in this area, and if it's an issue for you, it's something we can help with.
Okay, and what about CGT?
Well, transfers to a spouse are CGT free, but as with SDLT, it's a bit more complicated if there's a mortgage involved, but that can be sorted too. If you have furnished holiday lets or property used in your own trading business, then the gain can be held over so there's no CGT payable, and the gain is effectively deferred until the property is disposed of, which may be in many years' time. To summarise, that's why any fall in property values helps with planning, as CGT is payable on the market value as if you have sold the property or transferred the property at today's date. So now is a really good time to start planning.
So does this help with death taxes, that which HMRC calls inheritance tax and that which I call stupidity tax, because it's completely voluntary in almost all circumstances, and if you ended up paying it, it's because you didn't get proper tax advice?
In a word, yes. A lifetime gift to another is a potentially exempt transfer for IHT purposes. That means that the transfer is only fully exempt after 7 years. But here's the interesting thing. It's the value at the time of making the gift and not the then current market value. So that means if the property goes up in value by 50% in the next 5 years, it's today's value that is used for tax purposes. The gain is not included. And property prices are very likely to go back up. That's just the laws of supply and demand as it applies to property prices on our overcrowded island. Here's another important point to remember. If you die and have more than 2 beneficiaries, meaning you have more than 2 children, then the default position is that HMRC is likely to be the primary beneficiary in your estate without planning. We'll come back to that point later. I've been tax planning for more than 20 years, and I've met plenty of people for whom that's the reality. But I've yet to meet anyone who actually sets out with that objective for their lifetime's work.
Interesting. That's a very good point. What else should we be thinking about?
Well, rather than transferring assets to a company, it might be a good time to transfer them into a trust.
Okay, so what is a trust and what are the benefits of transferring property into a trust?
Well, on the government's website, HMRC defines a trust as a way of managing assets, money, investments, land or buildings for people. There are different types of trusts and they are taxed differently. Broadly, trusts involve three parties. The settlor, that's the person who puts the assets into the trust. The trustee, the person who manages the trust. And the beneficiary, the person who benefits from the trust. Planning with trust was first used in England during the 12th century Crusades. And as you would expect after all this time, it's very tried and tested and is subject to strict rules and regulations. That means it's standard stuff which can be very effective in estate planning. Property tax specialists use them a lot too. Capital gains tax can be legitimately avoided on a transfer of property into a trust by making a holdover relief claim. And that's available for all types of property. The relief appears to be generous, but that's just because it's treated as a chargeable lifetime transfer for inheritance tax purposes, which means that transfers up to the IHT nil rate band, which is currently £325,000, do not attract any tax charge. And you can do that every 7 years, as can your spouse if you've got one. That means that both spouses can legitimately transfer £650,000 of assets from their combined estate every 7 years without paying inheritance tax. Any excess is subject to IHT at lifetime rates of 20%, but only on the excess.
Okay, Neil, could pension funds be useful?
Yeah, definitely. Pension funds are just another form of trust, which in some circumstances can enable each spouse to accumulate another £1 million outside of the taxable estate. That's £2 million per couple, just in pensions. This really is a specialist area where we use UK HMRC tax-approved structures to enable clients to accumulate property in a tax-favoured environment. If you subscribe to the view I hear all the time, that nothing beats bricks and mortar, or my properties are my pension, then we need to run you through some legitimate non-mainstream options available to you, and there are several. In the right circumstances, your property portfolio could have no CGT, no IHT, and gross roll-up of rents. Think about that just for a moment. Gross roll-up of rental income either means more money available to pay down the debt quicker, or you could use the gross income to pay down a bigger loan. Either way, it's a no-brainer to at least consider it. And yes, there are circumstances where similar planning can work for residential property and not just commercial. Now we really are in technical planning territory, and every case is different.
Okay, it's worth reiterating that point. Much of the planning we do is for people who own residential property. And if we have a specialism, residential property planning is it. Back to coronavirus, it's affecting everyone right across the country and throughout the world. Is it too late to plan for the worst for those who own property and haven't done any planning?
Well, no, actually, and we're seeing quite a surge in interest in these areas, as you might expect. It seems that people, for the first time in a long while, have taken time during lockdown to think about where they're at and reflect on what they want to happen to their property portfolio when they die. Providing that you're fit and healthy, it may not be too late to plan, even if the worst does happen. We're going to be running a general session on this later in a couple of weeks, but I'm happy to have an initial chat at no cost.
What about those people who haven't checked that their existing planning actually works?
Well, now is really a good time to check that your existing planning is fit for purpose, and that's absolutely key. Martin, your earlier slide illustrates this quite well. You start out here and you're aiming to end up here. You hope your journey is going to be like this, but it's much more likely to be like this. Maybe you made a loss in the first year, then had a flying year, then a bad deal followed by some good ones, and the highs and lows are usually where the clients take advice. We typically find that clients have done piecemeal planning, often over lots of years and with several different so-called experts. Some of the original advisors are still around, but all too often they're long gone. in my experience, unless you've sat in the same room as your accountant, solicitor, tax expert, or maybe even your financial advisor within say the last year, then I'm going to guess that your planning is not in as good shape as it could be. Let's face it, if you're not in the room, then you're not really in the know, and it's your estate that we're talking about. That kind of inactivity is the difference between tax management and tax planning, and could be costly when the worst happens, and we're all going to die someday. That's where we can really help. We're independent, we weren't involved in the original planning, and don't have a vested interest in telling you just how good it is. Laws, rules and regulations, HMRC codes and practices, and even the mood of the country change very regularly. And in my experience, only a specialist property tax practitioner operating every day at the sharp end of property tax planning can really have the skin in the game you need for peace of mind that you're doing all you can to protect your legacy, and that what you're doing has worked for others just like you.
That brings us to the Rethink.Tax process. Can you describe that for me, please?
Okay, first, there are two types of tax planners. There are renovators and there are innovators. If you just want someone to manage your tax, then frankly, you're probably better off just sticking with your current renovator. But just remember, knowing is not doing, and it's doing that brings the results. If, on the other hand, you want an innovator, someone to get into your shoes and to use the skills owned every day at the sharp end of property tax planning with clients just like you, then we want to work with you. In my experience, here's where you're going to get with a renovator. And here's where an innovator can take you. Okay, so here's what we do. Many years of doing this has crafted a 4-step process. We need to first understand your circumstances, goals and aspirations. That means follow the facts wherever they may lead. Then we deconstruct and understand any existing planning. Think of it this way. If someone built a fence for you in the past, then we need to understand why. What was its purpose? And is it still needed? Does the fence need repainting or replacing with a new one? Next, we strategize. By that, I mean we put ourselves in your shoes, and with our detailed and up-to-date knowledge of all tax planning options that we've recently used for others, we make recommendations specific to your circumstances. Then we reload your tax and associated planning within HMRC rules, regulations and requirements. And then finally, and most important, we keep it that way. Because tax planning never gets finished. It only ever gets abandoned.
Neil, what about costs?
Good question. And that breaks down into 3 parts. By far the biggest is the cost of doing nothing and staying in the exact same place, which could be up to 40% of all of your worth. And I want you to do that. Just do the math on that. Seriously, just pause for a moment. In your head, add up the value of all your properties, take off any loans, and then subtract £325,000. And that's your net worth. HMRC gets 40% of that, and if you've got 2 children, they get 30% each. Then there's the cost of doing something, and that comes in 2 parts. Our initial review is free and without obligation. Then once we know exactly what's required, we'll quote a fixed cost for the planning, and we guarantee that we will stick to it. Even if we overrun, that's our problem, not yours. Here's how that looks on a slide. Here's what professional tax planning advice is worth to you. And here's what it costs you. Once we have your planning completely up to date, we'll provide you with a fixed annual fee to keep it that way. We're happy to work with your existing advisors, but if your current advisor is underwhelming, and I have to say that we have met a few, then we'd like to apply for their job. Please don't make the mistake of assuming that your existing planning works, because based on my years of experience, and literally hundreds of meetings with property owners all across the country, I can tell you that assumption can be the mother of all mistakes. It's worth re-emphasising that our property tax team consists of ex-PwC, ex-HMRC, fully qualified advisors who all specialise in property, tax and associated planning. We like to think of ourselves as black belts in property tax planning.
Neil, we're nearly finished, but just to unpack that a little further, typically, when I ask prospective clients, who does your tax advice, the thing I hear more than anything else is, I've got an accountant. Give us your thoughts on that one, please.
Well, at one level, that's a good thing. But remember, the primary task of accountants is to prepare and examine financial records. They make sure that the records are accurate and that taxes are properly paid and on time. Accountants and auditors perform overviews of the financial operations of a business in order to make it run efficiently. In essence, you pay your accountant to prepare your accounts in order to pay your taxes in a timely manner. Effectively, an HMRC policeman paid by you. Of course, some accounting firms are large enough to have specialist in-house tax teams. And if your business is big enough, you may even get the personal attention of a partner. And that's the world and charges that I left behind when I left PwC. In our experience, most small accountants simply don't have the time and resources needed to keep right up to date with technical property tax in a very fast moving and highly bespoke area of planning. But here's the thing, they can't tell the client that's the case for fear of losing them. So they do just enough to comply with HMRC rules and those of the Institute of Chartered Accountants or whoever their regulator is. That way they're beyond criticism and they get paid every year. But what they're not is proactive and creative for you, and you're paying them. That's where we come in, and I like to think that we're very good at it. We help a lot of accountants provide tax advice to their clients. By definition, the best advice will come from a tax specialist, not from a generalist, although there is room for both.
Great. Thank you, Neil. That's just about it for today, folks. We've covered a lot of topics in a short space of time, and as you're still with us, I'm guessing you probably have at least some concerns about the efficacy of your current tax planning. Today, we've taken a brief look at, is now a good time to transfer property? Then we moved on to look at why it's important to check that your existing planning actually works. And then finally, we took a look at what if the worst happens? And then we told you that it may not be too late to plan for that. I want to leave you with this thought. Now is the time either to start planning or to check your existing planning, because better tax advice helps you make better decisions. Let's just illustrate that. The last 5 years has been pretty much like this, but the last 5 weeks has been like this. Our best guess for the next 5 years is that the laws of supply and demand will prevail on this overcrowded island of ours, and property prices will return to where they were. It's just a matter of time. Coronavirus is real. It's happening now, and we're all at risk. In my experience, I think it's very likely that as owner and creator of your wealth, you've been through the pain and stress of risking everything for a dream that nobody saw but you. What you've created is your legacy, and you can decide who are the primary beneficiaries, your family or HMRC. But that takes planning. It won't happen the way you want unless you plan. I've been doing this a very long time, and I know from experience that real peace of mind comes from knowing that your planning is the best it can be. And I want to encourage you to protect your legacy just in case. Rethink.Tax is a coterie of experienced, qualified property tax specialists. We meet with property owners just like you every day of every week, and we don't get surprised too often anymore. And I'm pretty confident that whatever your circumstances, we've done something similar before, and probably several times. That's important, both because we know it works with others, so you know it worked for others, and that means you're not paying us to learn at your expense. While there can never be any guarantees, there is a peace of mind for all of us in knowing that what you're doing is tried and tested. And finally, if you take away just one thing from today, then please take this. Simplicity is complexity resolved. And that's what we do for you. I've been in and around the tax planning world for more than 25 years, working for clients large and small. Clients have said some nice things about us over that time, and there's some sample testimonials at www.Rethink.Tax. You'll find that link on the sign up page if you want to check it out. Okay, I said right at the beginning, we'll invite you to a free, no obligation Zoom meeting to look at planning which is most relevant to you. As you leave us today, a slide's going to appear on your screen. If you like any of what you've heard, just fill in half a dozen boxes and we'll email you a short summary outlining some of your planning options. Then, if you want to discuss them, we'll chat them through with you at no cost to you. The choice is yours. Okay, till next time, stay safe and healthy.